Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we're covering the Chapter 3 theory videos for the chapter Adjusting and Closing Entries. Now, I'm just going to pick right up where I left off from the last video. Okay, I'm not going to go back over any of it. All right, so where we're at is we were looking at this here process. Okay, and now I'm going to cover the slides from Chapter 2 so that you can see how it relates to this circular process here. Okay. Real quick though, we're going to make journal entries, post the transactions to the ledger accounts, create an unadjusted trial balance. That was all covered in Chapter 2, and in doing that work, from the trial balance, we actually created financial statements. Well, that's not where we do that. All right. In this chapter, we're going to cover the adjusting journal entries, creating an adjusted trial balance, then creating the financial statements, making closing entries, and then creating a post-closing trial balance. So let me head on over to the next slides. And again, I'm just going to cover this Chapter 2 stuff very, very quickly, but hopefully you'll see how it all falls into place. We had double entry bookkeeping, okay? And when we're, double entry bookkeeping allows us to not being able to cook the books, okay? If there's mistakes, you can't hide them, okay? Eventually they get all found out because of the way the system is created. So we have categories of accounts: assets, liabilities, revenues, equity, revenues, and expenses. We had talked about the normal balance being what increases the balances. Let me erase that. What increases the balances in these categories of accounts. And what the what is whether it's a debit or a credit. Remember, the definition of a debit is what's on the left side, and a credit is what's on the right-hand side. Okay, so we also have the accounting equation: assets equals liabilities plus stockholders' equity. And then we have what can be called the expanded accounting equation, right? For the simple reason that revenues and expenses are shown on the income statement, whereas assets, liabilities, and equity accounts are shown on the balance sheet. Okay. But the reason why we have an expanded expanded accounting equation is because the income statement accounts, revenues, expenses, and also the dividend account, which is still under equity, these are what are called temporary accounts, meaning they get closed out at the end of every accounting period, whereas all of your balance sheet accounts, they're as of a specific date. They never get closed. They're permanent accounts. So the balances in those accounts reflect the balances from the start of the business, whenever that was, whether it's 1 week, 1 month, 1 year, 10 years, 100 years. Even Penn Foster's case, where it's 125 years ago we started, the balance in our cash account shows what the balance is as of today, starting from 125 years ago. Okay, but your revenue and your expense accounts, if we were on a monthly accounting period, and today being August 25th, okay, well, it would only show the balance in, say, the I don't know, let's just call it advertising expense. The balance in the advertising expense account would only be from August 1st, okay, of this year. So you have permanent accounts and you have temporary accounts, right? So what happens during the accounting period? Well, you have journal entries, and journal entries are nothing more than recording the transactions that occur in the business. Okay, remember, everything that happens gets quantified. It has to be created. It has to be measured, and you do that by creating journal entries. Now, I went over a process in making journal entries, in that the first question I ask myself is, does this affect cash? Yes or no? If it's no, then I ask, does this affect accounts receivable or accounts payable? Okay, and if the answer to that is no, then I go to number 3 and I use an account that makes the most amount of sense. Now in making journal entries, and you can go back and watch the other videos and watch the homework assignments as to my thought process and how I ask myself those questions. We use the cash account the most. Okay, I'm just going to guess, but let's just say it's 65% of the time we use the cash account. Well, accounts receivable and accounts payable, we might use those, say, 20 to 25% of the time. Okay, well, that remaining 10 or 15%, we have to use accounts that make the most amount of sense. And often, when we're making normal transactions that occur during the accounting period, we rarely get to number 3. Okay, but doing number 3, using accounts that make the most amount of sense, that pertains the most when we're making our adjusting and our closing entries. Okay, and you'll see that as we go forward. So just realize that when you're making journal entries, am I affecting cash? If it's yes, then I know how to make a journal entry. If it's no, I use accounts receivable or payable. Well, if it's yes, I know how to make the journal entry. If it's no, then I'm going to want to use an account that makes the most amount of sense to start my journal entry and make that. But when we come to other types of journal entries, we have basically 3 other kinds. We have correcting entries, adjusting entries, and closing entries. And correcting entries we can make during the accounting period when we're making our other journal entries. If we know we made a mistake, we can immediately make a correcting entry, okay, in order to make sure that it's right. But generally, when we get to the end of the accounting period, we'll make correcting entries if we find that we've made a mistake, but we'll also make what are called adjusting entries and closing entries, and we'll cover that as part of Chapter 3. Just want you to be aware that there's other types of journal entries. Okay, so let's illustrate this here process of, it's the beginning of the accounting period. We have a transaction. This is the transaction, and you'll be familiar with this from the textbook. I mean, it's from the previous chapter. So you have a transaction occurs, and you have to make a journal entry. So you take that transaction and you figure out what the journal entry is, okay, and you put it in the journal. Now, when you have all of these journal entries in the journal, well, everything is all mixed up, so we have to post them to our general ledger accounts, okay, and that rearranges the information, okay, so that we're combining like information together. Okay, in other words, all of our transactions that affect cash are in the ledger account for cash. In this case here, all of the transactions that affect common stock are in the common stock account. All right? So we go from having a transaction, we take the transaction, put it in the journal, we make the journal entry for it. Whenever we decide to post our journal entries, whether it's daily, weekly, immediately, it's important, but the most important thing is that when we get to the end of the accounting period, we have to go through and make sure all of our journal entries are posted into the ledger accounts. Okay, and the reason why is because at the end of the accounting period, we want to know what the balance is in those accounts. Okay, now, before I talk about the trial balance, I want to just point out that the textbook is using T accounts as ledger accounts. Okay, in the real world, this is what most often, if you're doing it by hand and on paper, is what a general ledger account is going to look like. You're going to have a debit column and you're going to have a credit column, which reflects the transaction that you're making immediately, but then you're also going to have this here balance column, which keeps a running balance. Every time you make a transaction, you're going to have a new balance. You're going to always constantly updating that balance, okay, so that anybody who looks at the account will know at that moment in time what that balance in the account is. Okay, so just be aware that the textbook is using, these T accounts, okay, as ledger accounts, but in reality, you would end up using accounts that look, a ledger account that looks like this. Okay. So once all the transactions, are posted into the accounts. Okay, so that's what this slide was, and I just got done explaining that. We have our journal entries, and they're posted into the ledger accounts, but the book is using T accounts in order to represent that. And the reason why they're using a T account is because, when you look at an account, this is the cash account, so we could call this cash. And in a T account, we have a debit side and a credit side. So anytime we have a transaction that's affecting the debit side, we put it on the debit side. If we're looking at a transaction, like in the case here, this would be called common stock. We're affecting the credit side, we would put it on the credit side. So that's why the textbook is using the T accounts instead of the regular formatting or the more common formatting of a ledger account. Okay. All right, now, as you can see, and this may be the reason why they're using the T accounts, because it's a lot easier to show all of the information. Okay, because I have like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. I have 12 accounts here. Okay, now imagine that I had to get my eraser here. I would have to have 12 of these accounts, right? 12 of these ledger accounts. I have 2 on this page, okay? Well, if I had 12, I might be able to put a third one here, so I'd end up with like 4 slides here, okay? If I was using it in that format. But if I'm using T accounts like this, I can more readily see the information because I could see somewhat the transactions, and more importantly, then I can also see the balance in the account. Okay, so I think that's why the authors are using T accounts instead of ledger accounts, because now you can see all the information all in one place instead of having it spread out over multiple pages. Okay, all right, so at the end of the accounting period, let me go back and say, okay, here was the beginning of the accounting period. And during that time, we had transactions, which we created journal entries. And then we posted those to general ledger accounts. And we got to when we ended up with everything in the general ledger accounts, at the end of the accounting period, we would look at the balances in those general ledger accounts. So here's all of the balances in the general ledger accounts, right? Well, we take those balances and we create a trial balance. Now this is where in chapter 2, notice they didn't give it a name. They just called it trial balance, but they didn't say whether it was an unadjusted, adjusted, or whatever have you. Okay, they just said trial balance, right? And they used this information. All right, so just a quick bounce back up. Here, here are the balances in the accounts. Notice that the cash is $16,850, supplies is $350, equipment is $4,000. Well, you can see cash is $16,850, supplies was $350, equipment was $4,000. So they just transferred the information. They just rearranged it again from the ledger accounts, and they summarized it on the trial balance. Remember, trial balance is nothing more than a listing of the accounts and the balances in the accounts. And in chapter 2, he immediately went from the trial balance to creating the financial statements. Okay. You can see that we started out by doing the income statement first, and then then he created the statement of retained earnings, and that allowed us to create the balance sheet. Okay. Here's an easier look at it. Right. So if we look at here, service revenue has 3,100. We go back up here to our trial balance, and we can see service revenue has a credit of $3,100. We can see rent expense has $900, right? So rent expense over here is a debit of $900. So they transferred the information, and we're able to create the income statement. And from the income statement, we ended up with a net income, which then allowed us to create our statement of retained earnings because we needed to be able to show that net income. And that gave us, allowed us to have an ending retained earnings amount. And that ending retained earnings amount was able to be transferred over to the balance sheet. So we can't create the balance sheet until we created a statement of retained earnings. We can't create the statement of retained earnings until we have our income statement. Now, that's the way the information was being presented in the last chapter, okay? And that's where we left off, right? So what I'm going to do now is I'm 16 minutes into the video, and I'm going to stop the video here. But I want you to be able to just quickly take and see as an overview where we were at in the process here. Okay, we had step 1, we created journal entries. Step 2, we posted the entries to the general ledger accounts, and then step 3, we're able to create a trial balance. And in chapter 2, that allowed us to prepare financial statements. But notice we didn't do 4, 5, 7, or 8 here. Okay, and that's what chapter 3 is going to be all about. Now, I'm going to pause the video here, and I'm going to pick up right where I left off. So, just be aware of that. I'm not going to go back over all of this stuff because that was chapter 2 stuff. However, in the next video, I'm going to start to present some things slightly different. I'm going to use the information from chapter 3, but I'm going to show it in a slightly different manner that you're not going to see in the textbook. So just be aware of that when we get in the next video. Okay, so I'm going to pause the video here and see you in the next one.